the lesson on activity 4, I've chosen to go over the practice exercise solution and just give you more detail about why the calculations are what they are. So the first journal entry or first transaction was Georgian Auto Body bought a shop from an existing business, and they paid cash. The purchase includes the land, building, and all of the equipment inside. The total price for the purchase was $1,500. The fair market value of the land was $800,000, the equipment $400,000, and the building $600,000. Says calculate the cost allocation for this basket purchase based on the fair market values given. So the first step in order to do this journal entry is to add up the fair market value of all of the assets that you purchased. Figure out what each of these are as a percentage of the fair market value. So you would take 800,000 divided by 1,800,000, which gives you 44%. 400,000 divided by 1,800,000, 22, and building would be 33%. Then you take those numbers, multiply them by the amount that you actually paid. So you paid 1,500,000, 44% of that is 666,667. And the equipment would be 22% of it, and the building 33% of it. So the journal entry is to debit land 666,666, equipment and building, and credit cash for the amount that you paid. For the next journal entry in the practice exercise, and again this practice exercise comes out of the content from activity 4, on September 12th, Olympia Construction trades a truck with a historical cost of $24,000 and a fair market value of $18,000 for a cement cutter. The cement cutter belonged to Chi Brothers Construction and had a historical cost of $22,000 and a fair market value of $18,000. So you have to do journal entries from the viewpoint of Olympia and Chi Brothers. So Olympia traded a truck that has a historical cost of $24,000. So you have to take the truck out off your books at $24,000 because you want that account to be zero. So you have to credit truck $24,000. The fair market value of the cement cutter that Olympia purchased was only $18,000. So you also have to record a loss on disposal of the truck. In the books of Chi Brothers, they traded the cement cutter for the truck. Well, the original historical cost of the cement cutter was $22,000. The truck fair market value is $18,000, so they lost $4,000 on that disposal. So they have to take the equipment out at the amount they had it on their books at, record the new value of the truck, and record the loss. The last transaction is a capitalizing cost for a piece of land. And remember, when you're capitalizing costs, if it's going to benefit more than one accounting period, if it's significant or material, and they can be measured with reasonable objective evidence, then you can include them in the cost of your purchase price. So in this case, the land was $60,000. We had landscaping for $40,000, drainage and sewers for $30,000. The inspection was $5,000, real estate commission was $10,000, and legal fees $500. So we can capitalize all those costs into the cost of the land and credit accounts payable. Good luck with the content in activity 4, everyone.